one of the things that Mike brought up in the very start is opportunity costs. We're talking about, to borrow or not to borrow. When I think I threw out the car as an example. All right, here's bottom line. It's going to cost you one way or the other. It's going to cost you either by what that money could have earned, if should you pull out cash to pay for it, or it's going to cost you interest that you're going to pay a bank. So remember, we were talking about, this is the perfect setup, by the way, and this is like the big thing, to create the bank of you. Because now what you do is, let's say you go out and buy a vehicle, let's say you drop $50,000 on a vehicle, you borrow it from yourself, the insurance company is going to charge you whatever interest they're going to charge. People say, okay, but they're charging me interest. Yes, but your money is still earning interest. So it isn't like it was withdrawn, because that money is still actually earning money within the policy. You follow me?
Okay, so you want to let's take a $100,000 loan out. We're going to go buy us a new Porsche.
Okay, so we're going to take $100K out. Nice choice. It won't be a turbo. I can tell you that.
Yeah.
Firsthand. So you buy a $100,000 Porsche, and let's say, and I'm just making this figure up, the policy is going to charge you 5% to borrow.
Okay.
All right. The $100,000, it is as if it was still in there because the money was loaned to you. So let's say you earn 7% within the policy, and let's say it's performing at 7%.
Okay.
You just made an arbitrage of 2%.
Okay.
My attitude, if you're borrowing from yourself, is why not pay yourself 12%?
Sure.
All right? And then you put it back into the policy. So now you're paying yourself 12%. So you take that 12 plus that 2%, you just earn yourself 14%.
Right.
Does that make sense?
Mm-hmm.
So, and you don't have to, and this is now technically income, but you don't pay taxes on it.
Right.
Versus just giving it away to the bank.
Mm.
So what you're doing is you're paying you.
Right.
Back to my silly penny example, I will defer to that 1,000,000 times. It starts to compound. This thing starts to skyrocket like you would not believe.
And that's the point. 5, 10 years from now, you buy your cars, your house, your kids' education if you want, and the only person you're ever taking a loan from is yourself.
That's correct.
You never have to go apply for a loan again.
But let's go one other thing. Let's
Okay.
take it one step further. So let's say we want to have an income of, I don't know, let's say $500,000 a year, or let's say for someone, if that scares you, let's say $250,000 a year, whatever the case might be.
No, let's go for the 500.
Okay, we'll go with the 500. I like your thinking. So we have $500,000 a year. One of the things I like to do, using the rule of 72, basically about every 24 years, if we're using 3% as a capital, or excuse me, as an inflationary rate,
Right.
you divide that into 72, tells you how many years it's going to take in order to double your money.
Okay.
Bottom line is that in 24 years, that 500,000, you need $1 million
Right.
to have the equivalent of
To
500.
offset traditional inflation rates, and
Exactly.
who the hell knows what it's going to be for us soon.
And exactly, yeah. We don't want to open that door yet.
Yeah, well, that'll be another video.
Well, and then one of the things that I do for those purposes specifically is I don't even factor in the fact that you're not paying taxes on it.
Mm-hmm.
So I figure if I can match it dollar for dollar, gross dollars against my net dollars against your gross dollars, you're way ahead of the game.
Okay.
Which is literally what we're doing.
Right.
Okay, so
Yeah, you'd slap on another 40% in income taxes that you wouldn't
right.
be paying on this.
So let's say once we've done a calculation and we figured out, okay, this thing's going to generate $500,000 a year. So we've got that covered. And you and I had this kind of discussion, and conceptually they were saying, I like to leave a little bit of headroom in there
Mm-hmm.
because this is a great parking place for money.
Mm-hmm.
So now time doesn't matter. We're using it for long-term needs, but it also works great for short-term needs as well.
Mm-hmm.
If it's short-term needs only, this is not an appropriate vehicle,
Okay.
and I am stressing that.
Okay.
Some people will try to load you up and sell it to you, but no, that's not appropriate. The reason why you want to use it as a short-term vehicle is that, for instance, let's say if someone expresses to me that, hey, you know what, I'd like to invest in some real estate down the road.
Mm-hmm.
I don't know when that might be. I may actively start searching now, but for something that's going to meet my criteria, and I will tell you a piece of advice I give everyone, set your criteria and stick to your guns. Because the second you get emotional, it's a kiss of death. So what if it takes you 3 years to find it?
Mm-hmm.
In the meantime, you've got that money in there earning, and then you can always pull it out.
Right.
to now that'll be the downstroke on whatever that down payment is. And if you have enough money in there to fund the whole thing, it's a loan to yourself.
Exactly.
One of the other things that I think would be worth mentioning is doing just a quick comparison to the traditional, whether it be a SEP, a 401k, or whatever the case might be. Anything that we're going to call a qualified, in other words, government approved, qualified retirement plan.
And they know what to do with money, don't they?
Well,
You know,
let me
investment advice from the government, sweet.
I wish this was a piece of paper. I don't know if I did this with you or not,
Okay.
but let's just pretend. Imagine if I went up to you and I gave you this thing that was basically a check
Okay.
for $10,000, and I said, here's a check for 10 grand.
Sure.
Go ahead, take it.
Yeah.
All right. $10,000 I just gave you.
Yeah.
It's a loan.
Sure.
All right. What's the first question you're going to ask me if I'm lending you money?
How much is the interest on it?
Exactly. And I'm going to tell you, well, I'm not sure yet. The other question you're going to ask me is when do you have to pay it back, right?
Right.
So, Mike, I'll tell you what, I don't need the money right now. I think I'm all set, so I'll collect it from you at some future date. As far as the interest rate's concerned, I'll tell you what I'm going to do. I'm really not sure how much I'm going to need, so when that time comes, I'll do a calculation and I'll figure it out, and then I'll get back to you on that. Is that okay?
Hey, awesome.
You're going to cash that check?
No.
You're going to give it back to me, aren't you?
Sure, yeah.
That's what that is.
Right.
Uncle Sam is telling you you don't have to pay any taxes on that money today, so you're getting, you know, your deduction, and the CPAs are telling you, high five, let's throw as much money as you can. You can pay it back at some future date, and that's determined based on your age, 59 and a half to 70 and a half. And if you don't take it by 70 and a half, they start whacking you to the tune of like 60% penalty. You know, you have required distributions that you have to take out, minimums.
Right.
So bottom line is that the reason they don't know what they're going to charge is who knows what tax brackets are going to be.
Right.
Traditional planner is going to tell you, well, you're going to be in a lower tax bracket. Really? How do you know that? Well, because you can live on 75% of what you make right now. My first question for anyone who's into wealth is, why would you want to
Sure.
live on 75% of your income?
Poverty mentality.
That is a poverty mentality.
Right.
But even so, even if I subscribe to that, and then once I inflated it for dollars, and let's just give them the benefit of the doubt and say that tax rates are going to be identical, just by taking that number and now it's double, you're in a higher tax bracket already. So you're going to pay out the nose as far as the tax man is concerned. So paying taxes later, deferring paying taxes versus paying no taxes later, which would you rather have?
I'd rather pay them now and get it over with.
Well, you're going to pay taxes on the income. So as a good friend of mine, Doug Andrew, talks about, and he wrote a book, by the way, Misfortune. I'll put a little plug in for him. One of the things he mentioned, he said, would you rather pay taxes on the seed money or on the harvest?
Right, and you're going to pay taxes on a 50 grand investment or 150 that it's worth when you pull it out.
Yeah, and,
right.
actually, and hopefully it'll be worth a lot more than 150.
Sure. Yeah.
And an undisclosed, tax rate. So
So let me ask you real quick on the Bank of You and infinite banking and this particular use of life insurance. Is this something that the general public does, your average person does?
No.
It's not?
No.
Okay. And that means it's probably a good thing.
yeah, and as a matter of fact, I'll tell you what, by you just understanding these concepts, here's a scary thought. You know more than probably 80% of the people who out and sell this stuff.
Yeah, I mean, one of my first jobs was going to be a financial advisor at MassMutual my first year out of college. I mean, I went through the app process, took the tests, and I just couldn't get over it. I was like, why the hell am I going to be giving anyone financial advice when I've been doing nothing but waiting tables? I mean, it's scary. So, that's the whole purpose here of the Elevation Group is if you're doing the same thing that the general public is doing with their money, then you're not going to get rich. That's not the way to go. So if we're here to explore uses for money, means to grow wealth that the average person doesn't use and doesn't even know exist. And if that qualifies, it probably means we're on the right track. If it's something that your neighbor is doing and their neighbor is doing, it means that you probably should not be doing it. So, cool. What's next?
It's almost like that stock tip, by the way. When it becomes a stock tip that everyone's going around giving, it's too late.
Yeah. Totally.
Well, the next thing that comes to mind is sort of like what we're starting to talk about, and I'll kind of lay the groundwork on this way, which is it really kind of gears toward the legacy in terms of what we want to do, and I'll give you a perfect example of that. You're probably familiar with the Vanderbilt family.
Yeah, that little family a few years ago that was around.
Yeah, little family.
Yeah.
Well,
Made a little
actually,
money.
Commodore Vanderbilt was actually the Bill Gates of his time.
Yep.
With shipping, steam, whatever. Here's the interesting thing: there is not one millionaire left amongst the entire family and their heirs. And as a matter of fact, I think the last one, I don't recall the name, and it makes for a good story, but it is true. There's one gentleman who said he felt like he was plagued and he was cursed on account of that money.
Wow.
And that is because they never learned anything about stewardship. They were enabled their entire life. And let me relate that on a much lower scale, something that I personally did. I didn't have, and nor do I have, that kind of wealth. But I will tell you that growing up as a child, and I think anyone, as a kid, this has to go through your mind at some point, when your parents are either disciplining you or you go through a rough time as in your teens or early 20s when you're trying to make ends meet, and you remember vividly how miserable you were. You probably remember these tapes going in your head about, man, when I have kids, I'm going to make sure they don't have to go through the agony of what I just went through. Some of the things through osmosis you're going to end up doing anyway, and you are going to become your parents, but there's going to be several things that will stand out that you will in fact change. You've heard of the butterfly effect? It's almost like a ripple effect. Well, I did several things that I wanted to protect my kids with good intentions. I created a whole other set of issues that I was not prepared to handle. So one of the things that I did, and this is one of the things that we chatted about, and I believe I gave you a copy of, the template.
Absolutely.
Is, and this was inspired by another friend of mine by the name of Lee Brower, who's been a real inspiration to me and a mentor, very close friend. We still stay in contact. And that is discussing the family empowered bank concept. Now, he didn't come up with it. He's just kind of refined it to an art, which I've taken and run with it. Now I've done it with my own clients and my own family. I do everything myself first. So by the way, one of the principles that we follow, and I think that anyone that you hire advice-wise, and I don't care what field they're in, they should be able to walk their talk. So in other words, it should be something they've practiced also.
Right.
Sort of like when you set the stage about been there, done that. So here's the thing. This was designed by the Rothschilds. It's not a formally chartered bank. What we're actually talking about is...
So not the Vanderbilts, the Rothschilds.
This is the Rothschilds
Right.
now. And this family has got their act together. So I'll give you the simple version. My kids and I, we started a thing that we get together every other year. And we call it a family empowered retreat. We get together. And remember when I was taking the boxes, so to speak, and by the way, I did put a circle that I never finished filling out, which was my ideal vision of what I consider to be a sensational life. Because those are all the components. Think of it like a four-legged stool that leads up to, whatever we're going to have as a life.
Right.
So when we get together as a family, we discuss and do a knowledge share, almost like a mastermind, talking about all of them. So here's what I did with my kids. The first meeting went like this. We sat down, they were all excited, we're in Cancun. Actually, this was Playa del Carmen when we did it the first time. And I had them all around the table. It's almost like a workshop, till 8 o'clock in the morning to 12 noon. It's all business, and then we have nothing but family time and play. Pulled them aside and I said, I have an announcement to make, guys. Said, Nikki and I, my wife, we just finished putting our trust together, and they're kind of doing this. And I said, I got news for you. You're not getting a dime. Now, I was expecting to have the natives get restless and get all upset. They actually took it quite well. And they said, well, what's your plan, Dad? And I said, here's the deal. I think that I would rather, and I'm using this parable, I would rather teach you to fish than give you a basket full of fish.
Sure.
So I think if I share with you everything I know and teach you about stewardship and leadership, you're going to be that much better off. Because one of the things in hindsight, this is what happens once you hit 50. When I started looking back and reflecting on my life, I'm almost 50, I'm 49. Once you start reflecting on your life, you start wondering, you start looking at all the different things, in terms of, is there meaning, et cetera. And one of the things I came to realize is that a lot of those tough experiences, the bad experiences, were actually good experiences because I learned a lot from them. They made me who I am.
Absolutely.
So what I told my kids, and again, I'm getting it in a roundabout way, here's bottom line. Told the kids is that, guys, you have access to this money by way of a loan. You have to borrow. And here's the caveat. One, it's not going to affect you because the Family Empowered Bank is funded. the Family Empowered Bank is going to buy permanent life insurance on you whenever you borrow money for whatever enterprise or entrepreneurial venture, because I'm trying to encourage that with the kids.
And that's what the money can be used for.
It can be used for almost anything, but they also have to sell it to the rest of the family because it's done by the families like the board of directors.
Consensus.
Exactly. So while I'm around, I've got a big say. I've got the big mallet. But when I'm no longer around, they have to get together every other year, almost like a board meeting, and report to one another and lean on each other. So, together we are better, and that is our creed. But it's important to point out the permanent life insurance that I put in there, that also perpetuates the Family Empowered Bank, because even after they pay it back and they have to be in good standing, the policy stays in place.
So let's go over that one more time on what they have to do. Hey, I'd like to take out a $100,000 loan against the family.
Yeah.
Wealth. Okay, I get the loan. What are the requirements?
Requirements are, number one, as I said, they better have a good plan in terms of what they're planning on doing with it. Number two, it's going to be a note, and again, it's by consensus with the family. I do have some say in it because we're tying it into to the going rates, and I'm being kind because we're basing it on the prime rate. We're not doing prime plus 1 or prime plus 2, that kind of thing.
Okay.
And they also have to report back to the family. Every other year, as far as to the progress, that they're making with it. If they ever screw up and they don't pay it back, they're not shunned or cut off, but they are cut off until they pay that money back.
And you take out the other policy to do what now, and how does that work, and how does that fit in?
The other policy is really done in case something happens to them. Let's say they're totally on track and they're doing really, really well.
Yeah.
But God forbid, they get in a train wreck or in some kind of accident. The policy now is to make the Family Empowered Bank whole again.
To replace with the loan they took. Right.
Not only the loan, but ideally we want to have it be a little bit more than that.
Right.
All right. And the reason why is because, again, we're thinking about future generations. And one of the ways we did this, by the way, this is a governing document that we gave to our estate planner. And my estate planner at the time, the attorney, was joking with me. He says, "My God," he says, you're looking for, what is the term that Fred used? He says, "You're trying to get social reform," he said, with my estate plans. But he got used to it because this is what I was doing with most of my clients, because they really dug it. They thought it was really fantastic.
I think it's fantastic, too. Yeah. It's the best way that I've seen to pass on wealth that you've accumulated to your kids and force them to be responsible, with it. So I think it's awesome.
And again, I think my big key word that I like to key in on is empowerment. I want to empower my children. They're 20 and 25. They're not children, but to me they'll always be children, as opposed to enable them. Because frankly, Dad had spent their entire youth bailing them out and giving them every luxury that they've ever wanted. And I realized that I caused more harm, and I'm still dismantling some of that with. Particularly with my youngest, who's an artist, but I think that probably has more to do with the fact that he's extremely creative and brilliant, and artists just don't have the sense of urgency that most people have.
Gotcha.
But
awesome. I shared this with someone recently, and they were getting into the nitty-gritty devil's advocate details, and I didn't honestly have the answer, so I figured I'd ask you today. You pass away, and that's there, and it's growing. It's worth a lot. Who is in charge of it from a legal standpoint? I assume it's extremely important you have to be able to trust the estate attorney that is with. And
that's a real good question.
Yeah.
Yep.
Because they could take advantage of the kid's ignorance. So it's.
Yep.
Are there protections in place to help prevent that, or how do you? There's
not only protections, but there's also laws.
Right.
But like anything in life, there's not 100% guarantees. So what's to prevent, let's say, your bookkeeper who's managing all your money to not clean out your accounts and disappear? You don't have a guarantee other than hopefully they're bonded and all this type of thing. But I will tell you what I've done, and I can tell you what I've had most of my clients do. And frankly, the primary goal is to take care of my wife. If something happens to me, she's 100% taken care of. She has 100% control. Boys have to be on her good side because she can change a couple of things, although I've made some provisions in there that she can't change. And on the same token, because she has a nephew that she wants taken care of, that I can't mess with anything like that either.
Mm-hmm.
But we also have a second party, and yes, you do have to have someone you trust.
Mm-hmm.
Money does strange things to different people, which is why you usually will need to have an alternate. And it's also good to have a professional who's one of these folks who actually regulates all this. You can find them either independently. At the moment, I can't believe the term is escaping me, but nonetheless, it's almost like having a compliance officer.
Gotcha.
And they have to provide, the estate has to provide an accounting to whoever this person is who's overseeing it,
Okay.
to
Cool.
make sure there's no shenanigans.
Cool. Awesome. So if you don't mind, it would be awesome if I could share your family, I'll call it a painted picture, with everybody in the Elevation group. And obviously, we'll edit the numbers and take out the specifics, but I think it would be an awesome thing to share with folks so they can actually get a real example of it and see the details, because I think that's where a lot of the value is.
I think that would be a really good idea, because I think one of the things you can see with that is how the whole thing is set up, because we framed the whole thing in the beginning of the document. Because one of the things that, for those of you out there that are listening to this, one of the things that I do and my wife does is we tell our story. And I'll tell you, I'm getting chills just at the thought of it, because who I'm talking to are my future heirs that I'll never meet, because it's going to be multiple generations. So they get to understand, first of all, who am I, and what is the things that were going through my head as, look at this, I mean, I swear I have the goosebumps. And one of the other things we do now with technology is that with video.
Totally, live forever.
Well, that's the whole point, is that I also want to be able to tell, one of the things we started doing, when I left Boston, was we started filming people, families, tell their story. And we would ideally go after, let's say, a grandmother, a great-grandmother, it's just saying, hey, Granny, tell us about life when you were a kid. What are some defining moments? Which, by the way, is one of the things that I included in my document. What are some of the key defining moments that affected me? What are some impact? Who are some major influences? What made me? What do I think are either things, people, circumstances that contributed greatly to the type of person that I am as far as my core values and beliefs.
Totally.
But by capturing on video is kind of cool, because, and I'll share this with the group also, we just lost my wife's mother in October, and on that thought, the only regret we have is that I didn't go out there with a video camera, which I'm now planning on doing with my mother, who's in a nursing home, and we've been talking about it, and she's very, bless her heart, she's very self-conscious, because she has the equivalent of Parkinson's. She shakes a lot. I found out it's hereditary, because there's been a couple of times I'm like this and even my voice quivers and people go, are you nervous? I go, no, it's hereditary. But I'm actually going to go out and film my mom and ask her what it was like growing up. And she grew up in between South America and Spain. I have a Spanish side to me, and gosh, I regret, I lost my dad in 1993. On the Dutch side, I wish I could have asked him some questions, but I do have a lot of photographs of his childhood. And I remember the stories vividly if he told us about during World War II. My grandfather was, this is probably not relative to what we're talking about here, but this is the kind of thing you can capture. My grandfather was actually put in a concentration camp for hiding Jews, during the World War II. I mean, it's just fascinating background that, that we're going to put pen to paper and tell the story to future generations.
Yeah, no, it's awesome. It's setting... it's providing the leadership to set up the plan, and when you have a plan that everybody can buy into and get the details of and be inspired by, then it tends to take place instead of everybody losing focus and just going off and doing their own thing. So it's awesome.
There's one thing, if I may,
Please.
I would like to add one thing. When I was talking about the first diagram, that when I started scribbling up there and I put the circles saying, okay, this is your ideal vision of a sensational life, or your perfect life, call it whatever you'd like, and then we have the four-legged stool. There's four basic components is the way we've broken it down. And by the way, let me give credit where credit is due. That the way of presenting that, even though that concept has been around forever, there's people refer to them as pillars, they call them quadrants and everything else. But the one who really influenced me, and it came into my life at a very critical moment because of what my health challenges, et cetera, was Lee Brower. And he created something called the Brower Quadrant, which is attached his name to it. He does it a little different than what I presented, but anyway, the point that I'm trying to make, Lee, you owe me. I'm kidding. You can edit that. Now, one of the things that I want to point out here, and this is where, if I can make one thing really stick out to people, money's important, but it's not essential. I know this is all about wealth. I know this is about becoming millionaires. This is about people who are millionaires and how to protect it. But you have to understand that you have to really define your perfect life first, and then how the money is relative and how that sustains it. The money is a sustainability component to it. Because if we had a different medium of exchange, it would be something else. So it's not about greenbacks, if that makes any sense.
Might not be around much longer.
Well, that's, yeah, and that's a good argument to be had.
Yeah.
So the whole point is I try to tell people, and this is where I think the financial services industry is broken, they immediately go to the box and they start talking about instrument selection, or if you want to use a golf metaphor, club selection. This one's the greatest one, this one can do this. Who cares? It's relative to that. What I'm telling you is so important that a large company, in fact I can say it because it's public knowledge, Ameriprise, they forced it on their advisors several years back. They said they sent them out to have sensitivity training so that way they can relate to the clients. This is when they started having their dream, I forgot the exact terminology, but their dream conversations. What are your dreams? How would you like to do this? And people started really getting engaged and talking about it. But then what do they do? All right, let's talk about this annuity. Let's talk about this product. They immediately jumped to talking about financial instruments. And what they wanted to do was make sure that they had one of each. Mm-hmm. Why? Because their boss is telling them that you need to do asset allocation and you need to have one of each one of these things. And they're thinking very linearly. My attitude is, as I said, keep it simple. It's not rocket science.
Yeah.
You can use one of those instruments to accomplish several things rather than being loaded up with 3 or 4. Again, I can go on, and I won't for the sake of time.
Very cool.
I hope that helps.
Well, it is another conversation, but there's two lessons that I've taken away, right or wrong. It's just from my observation over the last 10 years is in the books that I've read and the people that I call mentors is I'll never walk into a financial planner's office or traditional one the way that I don't see you as a financial planner, even though you may have that qualification under your tool belt. And I will never take advice from anyone that doesn't earn at least as much as I want to. Is qualification number 2. And qualification number 3 is I will probably not ever put a lot of money in the stock market in a traditional way to make capital gains. Seeing what I've seen, because I think there's much better ways to put your money to work.